Gregory. Building AI applications is my job for quite a long time now. My mindset is always focused on business value and return on investment. Let me explain how I apply this principle to my own projects and investments. In my daily AI practice, I always choose use cases that deliver real and measurable value, and that's exactly why I decided to work on quantitative trading back in 2016. Stay in this video if you want to understand how to achieve a 50% annual return using AI and even outperform the Nasdaq index. The topic of trading in financial markets is huge, so I'll concentrate on a specific part, the exchange of high-growth technology companies. This area is best represented by an index called the Nasdaq, which is a weighted average of the most successful tech companies. For an individual investor, holding this index or an ETF that tracks it greatly simplifies diversification. However, while long-term holding usually shows solid returns, it also comes with periods of crisis that can easily scare investors. So that raises the question, should we try to trade the stocks ourselves? But then we face the full complexity of the markets, their reactions, individual company performance, macroeconomic events, and even price patterns. It can take individual investors years to get comfortable making those decisions, and trusting third-party experts is even more complicated. Here we really enter into the field of training model on data, where a human expert could easily get lost in emotions, uncertainty, or the fear of making mistakes, and that often stops real learning. This led to the idea of conditioning past financial data to train them in an AI quantitative trading model that will provide a well-balanced probability for trading decisions in the future. Quantitative trading is a fascinating but very challenging discipline. The main difficulty lies in the nature of financial data. It is highly stochastic and extremely noisy. As a result, models tend to overfit features that have no stable predictive power over time. To avoid any frustration, you can check out the GitHub repository with the source code of the method explained in this video. The link is available in the description. It will allow you to verify that the approach I'm presenting here can really provide statistical advantage on fastest growing tech stocks. This video is not financial advice. Please only use this kind of method if you fully understand the algorithms and the code. It all starts with data preparation, probably the most important part of the process, because your model can only be as good as your data. To make it faster, I use a single financial data provider with a Python API that lets me download daily prices, volumes, financial reports, earnings, ratio, ratings, and news. Only the news data are unstructured. All the other data are structured and can be organized as a time series table. Of course, by definition, time series are not really structured data. However, they tend to be more structured than text news. It will be also advised to add extra features or columns, for example, moving averages or indicators like the relative strength index. To supervise the dataset, I labeled the data into 3 classes to represent the main market trends: bullish, bearish, and range. To detect the trend, I simply look at moving average crossings of the price. If there are no crossings for a long period, I label the period as bullish or bearish class. For other part, I simply tag it as range class. A key aspect of quantitative trading is the concept of training, testing, and validation periods. A common approach is to define these as consecutive time windows, each serving a different purpose in the model evaluation process. The main drawback of this approach is that early stopping is often performed on the test period, if this test period does not cover a wide enough range of market conditions. The model may be imbalanced and struggle to generalize across market conditions. To avoid this issue, we can split the timeline into several training and testing windows while keeping a final validation period in the future. This way, early stopping takes into account a different range of market situations, leading to a more balanced and robust model. Another challenge is that the longer we make the training period, the shorter the test and validation periods become. This makes it harder to properly backtest the model over a long range of real market conditions, especially since the model selects the best opportunities among hundreds of stocks based on the predicted probabilities. One possible solution is to train two models, A and B, each trained, tested, and validated on opposite time intervals. This allows us to run a full backtest using only the test and validation probabilities without any discontinuity. An additional advantage of this approach is that it effectively doubles the number of test situations, providing a broader and more reliable evaluation. That's why, in this final backtest, you can see different colors on the chart. The traits shown in red correspond to periods where the model was trained on the blue intervals and vice versa. The final validation period, shown at the end in yellow and green, was never used for training or testing, ensuring a completely unbiased evaluation. I ran several robustness tests, performing multiple backtests in a Monte Carlo style where I randomly remove a portion of the stock list each day. This allows me to verify that the model maintains good performance even when the list of stocks is constantly changing. Now let's talk about model selection. At first, I explored a fully end-to-end LLM approach, which I'll show you in the next slides. But later, you'll see that I switched to a much more efficient classic method that requires far fewer computational resources. Since we want to handle two types of data, our goal is to see whether an end-to-end deep learning solution can process both structured time series data and the unstructured semantic content of news in order to make the best possible decision within a single unified model. So the idea is to see if a fine-tuned text-to-text LLM can perform well on this kind of scenario. So to do that, we convert the structured time series data into a formatted text prompt and simply append the unstructured news text followed by an instruction asking the model to predict whether the trend will be bullish, neutral, or bearish. Feed it into a classical text-to-text LLM with 8 billion parameters distilled with mathematical reasoning. We fine-tune the model with LoRa using the accelerator framework since we have a supervised training dataset and want to specialize our LLM in correctly decoding the target class. The purpose of the distilled LLM is to prevent the model's internal knowledge from influencing price predictions during backtesting. Distilling a model with mathematical reasoning leads catastrophic forgetting of past price patterns. This is exactly what we want, to eliminate any data leakage from the problem. A common approach when performing classification with an LLM is to use text decoder logits to extract class probabilities. However, the main drawback of this method is that the decoder is designed for text generation, not for well-balanced or controlled classification tasks. We could bypass the text decoder altogether by using the transformer heads framework that allows us to plug in linear probes at different attention layers to find a better classification solution. Nevertheless, I obtained a fairly good classification accuracy. That said, converting time series into text isn't very efficient, as the input context size quickly reaches its limit and temporal filtering the features becomes quite complex in this setup. Let's talk about temporal robustness filtering, or more precisely, how to remove features that don't show a stable predictive power over the time. To put it simply, if you are familiar with models like XGBoost, it provides a measure of how often each input feature is used during training. The idea here is to split the dataset into several time-based segments. Then, we train separate models on each segment and analyze the mean and standard deviation of feature importance across these models. Features showing a high standard deviation can then be removed because this indicates that the model may have overfitted on features that don't retain their predictive power over time. One way to do this in deep learning with transformer models is to apply LoRa to all attention layers for the first time interval, but then freeze the lower layers when training on the second interval. This way, the model naturally filters out the less important features, as only the most relevant representations remain consistent across intervals. Although this approach isn't formally documented in the literature, in practice it has shown very good results, especially when applied to standard dense layers rather than full transformer architectures. So it's easy to see that this approach is complex, risky, and computationally heavy to implement in deep learning compared to something like XGBoost. So if we look at the problem from the opposite angle, XGBoost offers excellent classification performance on structured data, with well-known robustness and very limited overfitting even when the dataset is small. Of course, it's not inherently autoregressive, so we need to support it by adding handcrafted temporal features, such as moving averages or the relative strength index RSI. In addition to temporal features, it's highly recommended to include ratios between key strategic features. Since XGBoost is essentially a decision tree model that relies only on comparisons. So now, the challenge is how to integrate the unstructured data. To keep it simple, one straightforward approach is to use a commercial LLM. The idea is to anonymize timestamp of data, process each group of news on a daily basis, and then ask the model to generate 3 scores from 0 to 10, one for the company's own news, another for its competitors, and a third one reflecting the geopolitical context, and then inject these scores into the table as time series features, adding also their moving averages. Of course, the main concern with this approach is potential data leakage due to the LLM's knowledge. However, as we'll see, we didn't find any formal evidence of bias. First, sentiment features are not among the top predictors in the model's feature importance ranking. The LLM's knowledge cutoff is set to June 2024. After that date, we don't observe any significant drop in performance. The model handled President Trump's tax reform quite well. Considering that the presented model takes short positions about 23% of the time, we can also see that it managed the COVID period effectively on the short side. It's likely that during a cutoff period, the gains would have been somewhat lower. Overall, we can reasonably assume that during any cutoff period, such as a war, a pandemic, or a major tax reform, sentiment scores would naturally decline anyway. Here you can picture the basic operation. During backtesting or live trading, we shift the input data window forward each day. By running inference with our XGBoost model on each stock in the watch list, we track the evolution of the normalized bullish probability over time, and we look for a threshold crossing as a signal to open a long position on a stock. In the same way, we look for another threshold crossing downward to close the position, a kind of probabilistic stop-loss approach rather than a traditional one based on a specific price level. In any case, for stocks, stop losses have limited effectiveness because of price gaps, stops, and can be triggered at levels completely different from the ones initially set. Regarding risk management, in the system presented here, there is no traditional approach using fixed stop losses and take profits with a gain to loss ratio above 2. Instead, risk management is handled differently. It's not based on crossing a price level, but rather on crossing a probability threshold. Risk can also be reduced through weighted diversification proportional to the signal strength. Thus, when a probability threshold is crossed, its level can be used to adjust the position size accordingly. Once the model is trained, we need to simulate its behavior over time using an initial capital. As explained earlier, we apply a backtesting approach based on 2 interlaced models, and we search for the optimal hyperparameters for opening, sizing, and closing positions in order to maximize backtest performance. So in total, this gives us 12 parameters to optimize 6 for each model, since we're using 2 interlaced models A and B. Now let's take a look at how the backtest function works. Basically, it calculates the performance of a position sequence based on the model A and B predictions, their hyperparameters, and available capital. For each day of the backtest, we select model and parameters A or B according to the current time interval defined by the current day. We calculate the signals to open the best long or short positions depending probabilities and parameters. We compute the signals that tell us which positions should be closed. Open and close positions according to signals, existing positions, and available capital to invest. Next, we calculate the current portfolio size by adding the remaining capital and open positions values. To find the best parameters A and B that maximize the overall performance of the backtest function, we need a stochastic optimization method suitable for non-differentiable functions. CMAES is a stochastic optimization algorithm. It doesn't use gradient, it explores a search space by sampling from a Gaussian distribution which is continuously adapted. Here on this animation, you can see how the method optimizes a 2D, a quadratic function. Of course, we will plug in on backtest function. The goal is to maximize it using a performance measure that reflects the investor's specific profile. After hyperparameters research, we could obtain this backtest performance, a total return of 1000% over the period, with a maximum drawdown of 18%, which outperforms the Nasdaq performance here in orange. Depending on how you initialize the random generator on the CMA-ES search setup and on the performance function you define in backtest function, you can actually get quite different results. Here is an example without spending excessive search time. Always keep some basic investment principles in mind when choosing your model. For instance, it's often better to focus on long positions. Try to make your full stock list as diverse as possible and use a performance formula that pushes the model to open more positions. That way you fragment your portfolio and reduce risk. The return might drop a bit, but drawdown will be lower too. This data-driven method can be applied to many other businesses. Don't hesitate to message me if you have a project in mind. See the link in description. If you enjoyed this content, don't forget to support me and see you in the next video.